Welcome to CoreLogic's update on the housing market for December 2018. Australian dwelling values continue to trend lower last month, with the CoreLogic Hedonic Home Value Index recording its weakest month-on-month change in dwelling values since the global financial crisis. National dwelling values slipped 0.7% lower over the month, led by larger falls in Sydney and Melbourne, where the pace of decline is accelerated. Nationally, dwelling values are down 4.2% since peaking in October last year, reducing back to levels last seen in December 2016. The downwards pressure on national dwelling values is largely confined to Sydney and Melbourne, which together comprise approximately 55% of the value of Australia's housing asset class. Since peaking back in July last year, Sydney's housing market is down by 9.5%. That's on track to eclipse the previous record peak to trough decline set during the last recession, when values fell by 9.6% between 1989 and 1991. Melbourne dwelling values peaked 4 months later than Sydney in November 2017, and they've since fallen by 5.8% through to the end of November 2018. Although the weaker housing market conditions in Sydney and Melbourne are under the spotlight, conditions across the Australian housing market are increasingly diverse. Dwelling values are trending higher across 5 of the 8 capital cities, albeit at a relatively slow pace compared with the previous surge in Sydney and Melbourne. Hobart and Canberra continue to be the standouts for capital gain across the capital cities, with values up 9.3% and 4% over the past 12 months. Across the regional markets, the highest rate of capital gain can be found across regional Tasmania and regional Victoria, while lifestyle markets are also continuing to rise in value, albeit at not quite the same pace as a year ago. We can point to several factors that are influencing the downwards trend in Sydney and Melbourne, while other regions are recording growth or holding steady. For starters, the tightening in finance conditions has been more pronounced across the investor segment of the market, where Sydney and Melbourne have recorded much higher concentrations of investment demand. As investor activity reduces, the fall away in housing demand is sharper in Sydney and Melbourne. Additionally, housing affordability constraints are more pronounced in these markets, and rental yields are substantially lower, indicating an imbalance between rental values and dwelling values. Also, the ramp-up in housing supply has been more pronounced in Sydney and in Melbourne against a backdrop of slowing migration from both overseas and from interstate. Additionally, Sydney and Melbourne have been more affected by the reduction in foreign buying activity. As a consequence of less market activity, advertised listings have surged higher, providing buyers with ample choice, which provides for a strong negotiation position on price. The rebalancing towards buyers over sellers in Sydney and Melbourne is clear across CoreLogic's vendor metrics as well, with clearance rates tracking in the low 40% range, while private treaty sales are showing substantially longer selling times and larger rates of discounting than they have over recent years. The Perth housing market has recorded another slide in dwelling values in November, down 0.7% over the month to be 4.2% lower over the year. The housing market weakness is most pronounced across lower value properties, with dwelling values down 6% across the lower quartile of the market over the past 12 months, while the upper quartile has seen a more moderate decline, down by 2.5%. The Perth rental market has been much stronger relative to dwelling values, with weekly rents up 3.9% over the past year for houses and 4.7% higher for units. The rise in rental rates is providing some upwards pressure on rental yields, which has risen from a recent low of 3.8% to 4.1% as rental rates outpace dwelling values. The weaker November housing market reading comes amidst tightening credit conditions, which are now spreading to the owner-occupier segment of the market, coupled with a deterioration in consumer sentiment relating to housing market conditions. The annual pace of credit growth slowed to 5.1% in October, according to the latest data from the Reserve Bank of Australia. That's the slowest rate of annual credit growth since October 2013. While annual credit growth for investment purposes has trended down to new record lows for some time, owner-occupier credit growth is now rising at the slowest annual rate since November 2015. Credit growth has been winding down since early 2015, in line with macroprudential policies. However, the recent trends have gathered some momentum after mortgage rates for owner-occupiers stepped 15 basis points higher through September to October, with investor rates up by 10 basis points. The disincentive of higher mortgage rates has been compounded by tighter credit policies and increased scrutiny of borrowers' overall debt levels, as well as their incomes and their expenses. Weaker consumer sentiment towards the housing market is also a factor in slowing the level of participation in the housing market. Westpac's House Price Expectations Index tracked to an equal record low over the past 3 months. Such a weak level of sentiment is likely to be weighing on the decision-making process for high-commitment purchases, such as purchasing a residential property. Investor sentiment may be being weighed down by the potential for changes to taxation policies related to housing, should there be a change of government next year. A negative gearing rollback looking to exclude established dwellings could diminish demand across the resale market, with less investment demand for properties with low rental yields. The halving of capital gains tax concessions would likely provide further disincentive for investment as well, on top of weak prospects for capital gains, premiums on investment mortgage rates, low rental yields, and fewer depreciation benefits. Typically, the catalyst for a turn in the housing market is a result of changes in interest rates or economic conditions. This time around, however, the market's been most affected by credit policies and availability of finance, despite very low mortgage rates and relatively strong economic conditions. Despite the recent out-of-cycle 15 basis point rise in owner-occupier mortgage rates, the cost of debt still remains at the lowest level since the 1960s. From an economic perspective, there are plenty of factors that should support housing demand and help to offset some of the headwinds. GDP growth is still tracking around trend levels, unemployment is tracking well below average, and at the lowest level since 2012, population growth remains strong, albeit showing signs of slowing, and wages growth is slowly lifting from a low base. These factors should help to support housing demand and offset a more material decline in dwelling values. We expect headwinds from tighter credit will continue for the foreseeable future and will continue to temper housing market activity. This will be especially the case for those markets where investment demand is the most concentrated and where housing costs are high relative to incomes, such as Sydney and Melbourne. With such a diverse housing dynamic across Australia's regions, it's all the more important to stay up to date on the trends. Check out your one-stop shop for housing market research at www.corelogic.com.au.